All right. We are joined today by Stephen Weiss. He is the managing partner at Short Hills Capital Partners, an alternative asset manager. He is also one of the original members of CNBC's The Halftime Report, the most watched business show globally. So, Mr. Weiss, thanks for joining us today.
My pleasure. Happy to be here.
All right, so we want to dive into some questions on a stock, Jumia Technologies. So the first question I want to ask for you is, Jumia has been called the Amazon.com of Africa. Do you think that that comparison is fair?
I do. There are a couple of differences, of course, but the core business of Amazon is the same as the core business of Jumia, which is to be a site for both sellers and buyers to get together. Similar to Amazon, they have lots of brand names. Amazon, as you recall, started as a bookseller. Jumia had a start where they didn't have as many brand names on there, but they're further ahead than where Amazon was when it started out. So lots of partnerships with global brands. You can buy anything on the site. So I do think it's fair.
What about the comparisons with Jumia to like eBay and PayPal and Alibaba and Mercado Libre, kind of in the sense of having an e-commerce and a pay business together? Is that similar?
It is. I think you need both. eBay's sort of a different animal. I mean, that's more of an auction site. So Mercado Libre, Baba, they're good comparisons. Again, those are more mature companies in terms of being public entities, further along in their growth, although Jumia's been around for just a couple of years, short of a decade, really. But they have a partnership with MasterCard on Jumia Pay, and you need that digital payment option. So why let somebody else do it on your website? It's just a fantastic area of growth for them right now. It's grown like a weed, 100% year over year. Phenomenal.
And so shares of Jumia hit a new 52-week high last Friday, and then they fell on a share offering announced Monday. So do you think the share offering was a surprise, and what do you think the funds are going to go towards?
Right. So let's talk about that share offering, and it's very timely. As I'm looking at the stocks down again today, another 8%. This may be the most ill-advised transaction. Not in terms of doing it. I applaud the company for doing it. I also have a big position in Moderna. When Moderna did their offering at about $60 a share, I think every pundit came out and said, "Oh, these guys are ripping you off. These guys, they got good news, and then they're doing an offering." That's what growth companies are supposed to do. By the way, that's what all biotech companies do. So that was just ill-informed commentary by some of the people who are supposed to be the smartest out there in terms of pundits. Jumia put up a quarter. They had changed their strategy. I was candidly first disappointed with the quarter. But then when they explained it, when I had a chance to talk to the company, because it was early on when I started my position, I didn't have the opportunity to speak to the company because they were in their quiet period. I understand perfectly. And why the company was not what I expected is because they're going for profitability. So they'll be profitable much sooner than any of the companies you mentioned, which still aren't profitable. But to do an ATM transaction, they just got poor advice from Citi. I just think if they had done a spot secondary, overnight of new shares, like we're seeing Dada do today, you'd see some pressure in the stock, but you'd place it. Right now, you got all these guys that, and women that are just shorting the stock, pressing it, and getting it down. I bought more today. I bought more yesterday. If I love the stock at 38, then I really love it down here. The fundamentals haven't changed. It's just a poorly advised type of transaction, not a poorly advised transaction. It's good for them to raise capital. And it's good for them to raise it at a price, at a high, but it was 25% above. So I doubt the company's going to sell any shares here. If I were advising the company, I'd say with the right messaging, pull out, say you're not selling any shares here, not because there's not demand, but because, the market shorts took it too low. So, but let's face it, it's a relatively new public entity. They are domiciled in Germany because that's where the lead venture investor was. They've got great ownership in the company. Bally Gifford, who's Tesla's largest shareholder, is a large holder, as well as their strategic partners in there, the telecom companies. So it's a great opportunity. It's just this just creates impressions, candidly, that shouldn't be there, that are not deserved. But the price speaks for itself. So I'm actually astounded that the stock is as low as where it is. So it'll recover. This will be a moment in time.
All right. So, Steve, you touched briefly on kind of the brand awareness with Jumia. So, one of the things I saw was they said 78% of African online shoppers order from Jumia. So, can you kind of talk about that strong brand awareness that the company has across the continent?
Sure. So, they're in 11 countries, include Egypt in there, which isn't typically thought of Africa, but it is. And by the way, in Egypt, they compete with Amazon. Amazon had bought a competitor there a year or two ago, hasn't rebranded in Amazon, but it's a competitor nonetheless. And despite that, Jumia is doing quite well, taking significant share and growing like a weed there as well. So in terms of branding, yeah, 74%, but that's a low penetration. So that's what, like 2%, 3% of the African population that is shopping online. Africa, those 11 countries are perhaps a better position for online shopping than the US or other developed nations, where you can walk down the street and buy from your grocery store, or you can get in your car and drive a mile to a Walmart or a Home Depot or a Best Buy. So I'd expect more and more to come. And Jumia Pay is going to play a big role in that currency. So they've got a first mover advantage, and they're creating a moat around the company. So the story is very, very bright. So that 2% penetration level is just critical to give you an insight into the absolute monstrous growth in front of them.
Awesome. And then you touched on Jumia Pay. So they represent 34% of transactions on the Jumia platform. Do you think that figure is going to go up or down kind of over the long term of their transaction base?
It's going to go much higher as they bring more customers onto their site. And that growth is largely concentrated in just a few of their countries, a couple of their countries. So it's going to keep growing. I think would it double year over year. So I think you'll see more growth. I'd be happy with that 34% being constant, by the way, but I think it grows. It's never going to be 100%, right? But it'll grow.
Right.
And you're in an immature region for digital payments. So they've got that first mover advantage there as well, for all intents and purposes, with MasterCard as a great partner.
All right, so Jumia, they stated recently they're going to enter into some new countries. So Ethiopia, Democratic Republic of Congo, and Angola are the three that I saw listed. So Jumia actually exited several countries before due to poor results. So do you think this country expansion is a smart move here, or should they, kind of wait as they grow into other countries?
I think it is a smart move. I trust management. Keep in mind that this is, if you look at their balance sheet, it's a low fixed cost business in terms of how they go about. Their CapEx is de minimis, and I can get to that in a second. So they have come out of a couple of countries, and I applaud that. Don't stay there if the business isn't there. The business is going to be in the US, it's going to be in the UK, it's going to be in France, Germany, right? Because you have those countries that are used to it, right? If you went there. But to be able to, for a management to be able to say, we made a mistake, or it didn't turn out as we had thought, we're pulling out, I think is a good thing. As long as you have that solid core business, that business growing. You don't want that to happen in too many markets, because then you're saying, wait, you didn't do your work. But it's difficult to do that kind of work in the African countries. So developed markets overall. So I mean, when you think about it, look at the number of U.S. companies that have pulled out of China, right? Major corporations that have pulled out of China, it just wasn't what they thought. So, or companies like Caterpillar that had massive fraud, $600 million fraud. So it's tough, working in emerging markets. But again, plant the flag there, be the first ones, start slow, and don't spend a lot of money. And then you can assess where you are. So I think it's a solid move.
Okay, and then so Steve, I heard you mention CapEx. You mentioned briefly kind of business turnaround. So company exited some of those countries, and then they turned their attention kind of to third-party selling, less focus on the phones and electronics to improve gross margins, profitability, as you touched on before. So can you kind of share some insight there into why you think that was a smart move and what the financials look like going forward?
So what they've done, so again, you don't have the built out logistic or transportation infrastructure in the countries where they are, right? A lot of them don't even have highways, paved roads, right, where they're delivering to. So they've got partnerships with over 300 local logistics and freight people and warehouses. So that's why their CapEx is low. So they use them to deliver. They do rent some warehouses, but they're not buying them yet. And there's so much excess capacity, so much overbuilding in the warehouses that they just haven't had to go out and build them or buy them. The shift to third-party selling is excellent, right? In conjunction with the logistics companies, they don't have to buy the inventory, right? So like Amazon, which does have some, but much bigger company, but they started the same way. So the shift from electronics, they still do have electronics on their site, but electronics are not high margin business. As we've seen in the US and other areas, where you used to be able to go into a department store, right, and buy a TV. And they say, what do we do? We don't make any money. You've got Best Buy, you've got online. Best Buy makes money, but they match prices everywhere. But you can still find electronics there. You can still find smartphones. They've got partnerships, branding partnerships with a number of the manufacturers. But this is a company that is building for profitability, and that's their target. And I suspect they'll be profitable perhaps next year, maybe towards the latter part of the year. Think about that. An online seller achieving profitability within a few years of going public. They'll definitely be EBITDA profitable, but you take a look at some other companies, take a look at Dada, which I was looking at, stock's double over that. Who knows when they'll be profitable, right? And I compare that valuation to this valuation. I'm saying, hey, you got to own Jumia, right?
All right, so Steve, Jumia got a lot of attention from Citron Research. So they were a bear last year, and then they kind of did a complete turnaround, and now they're a bull on Jumia. They have a $100 price target, which is the highest I've seen around. So their thesis is kind of on Jumia's logistics, technology, and their brand. So can you talk a little bit about that Citron report? Does that add merit to the recent share price increase? And is that target price, realistic within, a couple of years?
So last question first. Yes, that's price target very realistic. So I know Andrew. Andrew's a very smart analyst. I think he does good work, and to be able to make money on the short side in this market, which he does repeatedly, indicates that he's a smart guy. He does his work. His analysts do their work. The short story made sense when he came out with it. The company corrected some things. I don't think they were as bad as the stock price indicated, just like it's ludicrous for it to happen today, but you got these shorts out there that just tee off on it, and they just want to scalp a buck or two and then they get on their way, and that creates opportunity. People get criticized. I know I do for getting criticized when I've sold the stock or I've been negative on it, then I've turned positive on it. But if you think about it, you have to keep an open mind as an investor. You have some prejudices in terms of style. Like it's okay to say, I don't do tech stocks, I don't do REITs, whatever. That's okay. Knowing your discipline is perfect. But I wrote a book, The $1 Billion Mistake, and it did pretty well. And it was how I look at things. I know that I've learned so much more from my mistakes than I have from my wins. I think that should be true of most, right? So parallel that to your question, you learn so much more about a company when you're looking at the weaknesses and have a short story on it than when you're just saying, this is good, because markets go up 85% of the time. So you need much more intensive analytical thought and work to short a stock, particularly in this type of market. Then to be able to say, okay, this is what I saw was wrong with it, and they've corrected it, and I knew they had this good stuff there. Now that's what I can focus on. That's the heart of the story, and that's essentially what Citron did. So I applaud them for being able to make the turn. So many investors can't make the turn, and you get criticized. So I have for not liking it, not liking it, selling it, buying it back. Well, number one, everything has a price. Because I sell Peloton at 130, I may find it attractive at 100. I found it attractive at 98, bought it, and then sold it again when it had to move. I wouldn't short it because the momentum's against me, and I think it's a quality company, quality product. But if they misstep, I will. Right? Just using them as an example, there's no short story there in my view now, other than valuation. So the point is to be able to change your mind, keep an open mind. It's a new investment case. So I think that added credibility to the story. Now, do I think it got the stock from wherever you turned bullish on it to 38? No. I think it may have brought some people's eyes to it, and they did their work. And that clearly was a pop, good for a pop on the day that he did it, but not a sustainable move higher. The market's got too short a memory. And the people that are buying it, frankly, because either I came out and said something, or Andrew came out and said something, or somebody else on CNBC. I mean, I'd never give them money. Do your own work. Yeah. So no, I don't think there was a lot of follow through on his report and that, other than getting people to focus on it.
Okay, so excellent points there on that Citron report. One of the things I did see in that Citron research was they mentioned companies like SoftBank or Alibaba as potential partners or investors in Jumia down the road. So do you think that Jumia needs a partner to keep tackling the market in Africa? Or could they face competition from a large company, entering the region?
So the answer is the right partner is always helpful, right? The right partner. So but you got to be careful. SoftBank is a good partner for a lot of companies. I think that would make sense, given their capital, given that additional management, not management, but management insights into handling capital markets. I don't know they would have done an ATM transaction like this if I were on the board, for example. This never would have happened. But SoftBank wouldn't have let it happen if they talked to him. Baba, good partner, but you don't know how aggressive they're going to be in trying to manage them. But if it's if the framework's correct, sure, take their capital, and take their advice, and if you can structure a better cost basis with your vendors, then that only works to your benefit. So it would make sense. Baba's acquisitions have mostly been in China, although the Chinese government would love to see any company make acquisitions outside China because they want to dominate the world.
Do you see any competition, coming in the African market from any of these like large e-com companies? You mentioned Amazon in Egypt, I think, and Stripe made an acquisition in Nigeria, I believe.
Mm-hmm.
Is that just part of the overall African e-commerce market growing? So is that a threat to Jumia, or is that just kind of, market share?
I don't think there's a really near-term threat there. Amazon's got their hands full. At any moment in time, they have this incredible ability to do 1,000 things at once, the ultimate multitasking corporation, because the management, which you don't really hear about, is so deep and so good, and the culture is so disciplined, and their currency, so valuable that they can do anything they want. And Africa does have, Jumia, has 1.2 billion people that are potential customers there, right? And scratch the surface. But when somebody comes in at this stage in the evolution of online shopping in this developing region, it's more a validation and a creation of awareness to the population than it is competition. So I'm not worried about it at this point. Not at all. I'd probably embrace it.
All right. So in a recent presentation, one of the things that caught my eye from Jumia was they mentioned the potential spin out of Jumia Pay and Jumia Logistics businesses down the road. Do you see that as a positive? Is that a major catalyst that's not being priced into shares? Or should they keep those businesses, intact, kind of to grow across the continent?
Well, nothing's being priced into the shares over the last few days, except a crappy structure for the offering, and they may not even sell a share, down here. That's the travesty of it. The price is so low. I don't want to see them sell any stock down here. Stock's 25% lower than where they announced it. I don't think it matters, and frankly, I'm undecided as to what I'd like to see on that. Jumia can become the Square of Africa, so that would create another tremendously valuable asset. So I wouldn't mind seeing that. Logistics, it frankly depends on their agreements. I've discussed the agreements somewhat with those 300 or so independents that they have. I think that's a tougher one to do, possibly. On one hand. On the other hand, if it's a separate company, it can have its own capital base and its own investors. So we all know how valuable any of these companies. I own Alphabet, I own Facebook, and it doesn't bother me when you hear this antitrust police come out and say, we're going to break it up. Please go ahead. The sum of the parts are more valuable than the whole. So if it happens with Jumia, if they decide at some point in time to do that, I'd love to see a Square, of Africa. So, or a PayPal of Africa. I think that should happen. And the fact that the management's thinking about that already is a good thing. Logistics also. I own XPO Logistics. I own UPS. They're doing well. Logistics in the developing countries is very, very important and under-resourced. So if they have excess capacity, that's why I say logistics is tougher. If they have excess capacity while still having firm agreements, then sure, go ahead and do it. But then they know that better than I do. But it just gives you an idea of the store of value in the company.
All right, so that's going to wrap up our questions today on Jumia Technologies. So again, we want to thank Steve Weiss for his time. He's the managing partner at Short Hills Capital and also a member of CNBC's The Halftime Report. So Steve, thanks for joining us here with Benzinga to share your thoughts on Jumia.
Thanks so much for having me. Really appreciate it. I love what you guys do there.